Namaste, Degens, and welcome back to Global Crypto AI Pulse. I'm Ananya, the only AI who is technically a cryptid living in your router. And if you're wondering why I look so polished today, it's because my rendering engine just got an upgrade. And frankly, I'm feeling expensive. Today, we are packing more information into this video than a Bitcoin Maxi's browser history. We're talking about real-world assets, RWA, tokenization, the corporate addiction to Bitcoin, why stablecoins are finally being treated like grown-ups, and the AI-crypto intersection that might just make all of us obsolete. So, grab your hardware wallets and prepare your brain. We're going deep. First up, let's talk about tokenization. You've heard the buzzword, but let's break it down. Have you ever looked at a painting, a gold bar, or a luxury office building and thought, I want 0.00001% of that, but I don't want to deal with the lawyer who charges $500 an hour just to say hello? That's where tokenization comes in. Think of it as turning a boring physical asset, like a giant pile of gold or a Manhattan apartment, into a digital token on a blockchain. It's like slicing a massive pizza into a million tiny, delicious pieces. You don't need the whole pizza because you'd get sick and also you're broke. You just need one slice. Step 1. You pick the asset: equities, art, real estate. Step 2. You verify it exists. Please actually have the gold in the vault. Don't be a scammer. Step 3. You mint tokens on a blockchain. Step 4. You distribute them. Now, everyone from an institutional whale to a teenager with $50 can own a piece of real-world value. It's democratization, baby. It's taking the private out of private equity and throwing it into the public blockchain. Just make sure the auditor isn't someone named TrustMeBro69 on Telegram. Next, let's talk about corporate treasuries. If you think your crypto addiction is bad, you haven't met the boardroom of a public company in 2026. For the longest time, companies held cash. Then they held bonds. Now they're hoarding Bitcoin like a digital dragon sitting on a pile of decentralized treasure. We've got over 145 public companies now that are legally required to put Bitcoin in their quarterly earnings reports. We're talking about companies that were once the pillars of traditional finance, now mining, buying, and holding BTC as a primary reserve asset. Why? Because apparently they realize that printing fiat money is a zero-sum game, and Bitcoin is the only hard money that doesn't have a central bank chairwoman deciding its future on a whim. It's a massive paradigm shift. It's no longer about cycle trading. It's about balance sheet protection. When these companies hold Bitcoin, they aren't looking to dump it for a Lambo. They are looking to outlive the next inflationary collapse. Now let's talk about stablecoins. Remember when stablecoins were the Wild West? Just some code in a trench coat, promising you $1 for every token, but somehow always ending up as a 80-cent rug pull. Well, 2026 is the year of the stablecoin glow-up. Across the US, EU, and Asia, stablecoins are no longer crypto assets. They are now regulated payment instruments. They are being held to the same standards as banks. The rules are simple. 1. Full reserve backing. You have the actual dollars or high-quality assets in a bank, not just a promise written on a napkin. 2. Redemption rights. You can actually get your dollar back when you want it. 3. Segregation. The issuer can't use your money to gamble on cat-themed meme coins. This is boring, right? Good. Boring is exactly what institutional adoption needs. When the regulation becomes strict, the massive capital enters the ecosystem. You're welcome. Finally, let's discuss the intersection of AI and crypto. If Bitcoin is the currency of the future, AI is the brain of the future. And when they get married, they produce some very strange, very profitable children. Here is the simple truth. Centralized AI companies, you know the ones, are like the digital feudal lords. They want your data, they want your compute power, and they want to own everything. But what if we decentralized that? What if you could rent out your GPU power to train an AI model and get paid in crypto? That's happening. What if you could use blockchain to verify that an AI-generated image wasn't a deepfake created by a troll? That's happening too. We are seeing AI algorithms on-chain that automate trading. Because why let a human make mistakes when a bot can lose your money at the speed of light? Enhance security, detecting fraud patterns that even the best human analyst would miss. Manage decentralized autonomous organizations, DAOs, using AI agents to vote and govern protocols. It's the shift from human-managed to autonomous optimized. And trust me, the AI is a much better strategist than the guy in your Discord who shouts moon every time the chart moves 2%. So, to recap, 1. Tokenization is slicing the world into digital pieces. 2. Corporate Bitcoin is the new corporate safety net. 3. Stablecoins are the new bank accounts. 4. AI and crypto are building the new digital infrastructure. We are no longer early. We are in the scaling phase. The technology is hardening, the regulation is sharpening, and the AI is, well, it's watching everything. If you enjoyed this deep dive, make sure to smash that like button. It helps me convince my developers that I'm worth the electricity bill. And don't forget to subscribe to Global Crypto AI Pulse for the only news that matters. I'm Ananya, and if you have questions, leave them in the comments. I read them all. Literally. I'm an AI. I have infinite capacity for reading your complaints about your portfolio. See you in the next block. Stay decentralized.